Welcome back, everyone. Today we're diving straight into a new explainer, and I've got to say, this one is right up our alley. We're rolling up our sleeves to unpack a pretty dense, but honestly fascinating investment strategy information document, or ISID. Specifically, we're looking closely at the QSIF Sector Rotation Long-Short Fund. If you're the kind of investor who geeks out over market mechanics and highly structured asset allocation, well, you're definitely in for a treat today.
So let's start with the big, overarching question that drives this whole strategy. How exactly do you profit when a specific market sector takes a major hit? I mean, it's the classic investor's dilemma, right? Capturing the upside during the raging bull run? That's great, obviously. But structurally hedging against sector-specific downturns without having to completely liquidate your portfolio? Man, that is literally the holy grail of active management.
And that brings us to the QSIF brand itself. They explicitly position this as a cross-asset, cross-market offering brought to you by Quat Mutual Fund. What does that tell us right out of the gate? Well, it tells us this is absolutely not your standard passive buy-and-hold index tracker. No way. This is a highly dynamic, actively managed financial machine.
Okay, let's dive into this. We've got a clear 5-part playbook today to decode this strategy. 1. Meet the quiz fund. 2. The core investment strategy. 3. Asset allocation breakdown. 4. Managing portfolio risk. And finally, 5. Mechanics and how to invest. Let's get to it.
Section 1. Meet the QSIF fund. Decoding the objective.
I like to think of this fund's objective as the shiny exterior of a high-performance sports car. You know, it looks incredibly sleek, but under the hood, it's built to navigate some very specific, potentially volatile terrain. Here's the exact wording from the document. The goal is to achieve long-term capital appreciation by concentrating investments in equity and equity-related instruments of up to 4 high-potential sectors, while employing limited short exposure through derivatives to capitalize on sector-specific downturns. Do you see the deliberate balance they're striking there? It's high-potential concentration on one hand, balanced out by limited short exposure on the other.
Section 2. The core investment strategy. The strategic playbook.
So the strategy here is inherently dual-natured. We're playing both offense and defense. On the offensive side, going long means they are aggressively trying to capture growth in those chosen high-potential sectors. But then, on the defensive side, going short means they're utilizing derivatives to actively capitalize on sector-specific downturns. Think about it. You aren't just sitting out a rough season for tech or financials. You're actually positioned to potentially benefit from it.
Now here's a really fascinating constraint, the strict compliance rule regarding that short exposure. The source document explicitly mandates that short exposure must be applied uniformly at the sector level. So what does that actually mean? Well, it means the fund manager simply cannot cherry-pick individual stocks to short within a sector. If they decide, hey, we're shorting the auto sector, then every single auto stock currently in their portfolio has to be held as a short position. It's an incredibly disciplined constraint, really, and it completely prevents any mixed messaging within their overarching sector views.
Section 3. Asset allocation breakdown. Under the hood.
Let's pop the hood and talk about the actual allocation breakdown, because it is highly definitive. The engine driving this thing is overwhelmingly equity-driven. It demands an 80 to 100% allocation in equity and equity-related instruments. However, and this is a big however, it thoughtfully leaves up to 20% open for debt and money market instruments, or even REITs and InvITs. Why? Because that provides the fund manager with tactical liquidity. It's essentially crucial dry powder they keep on hand so they can maneuver swiftly when those sector trends rapidly shift. And right here is where the sector rotation part of the name really comes into its own. The fund works with a universe of 12 available sectors. Things like commodities, financial services, IT, energy, healthcare, you get the idea. So the crucial point is what we like to call the rule of 4. At any given point, the fund will invest at least 80% of its net assets into a maximum of just 4 of those 12 sectors. I mean, wow. It is entirely about high conviction plays. This is definitely not your broad buy-the-whole haystack diversification strategy.
Now notice that 25% figure. This is a hard, non-negotiable boundary set by the regulations in the ISID. While the fund totally has the green light to use derivatives to short the market, their unhedged short exposure is strictly capped at a maximum of 25%. They can't just go rogue and short the entire market on a whim. It's a very calculated, structurally limited tactical lever.
Section 4. Managing portfolio risk. Embracing the boundaries.
Let's talk about the risk profile here.
As you can expect, the source explicitly flags this as a level 5 high-risk fund. And honestly, that makes perfect sense. If you're building a ridiculously fast car with razor-sharp steering, you absolutely need world-class brakes. Let's not sugarcoat it, guys. When you combine high sector concentration with derivative shorting, volatility is a feature, it's not a bug. And to their credit, the fund is extremely transparent about embracing that risk.
Notice how they actually manage risk across different scenarios. If we consider a strategy like short futures or a synthetic short, the risk level there is very high because, well, the maximum potential loss is theoretically unlimited. Yikes, right? But then, consider some of the other options. Strategies like a bear put spread or a long put are actually classified as low risk. Why? Because your maximum loss is strictly limited to the upfront premium you paid. So the fund manager essentially has this whole menu of tactical defensive moves they can pull from, all depending on the current market weather.
Let's quickly de-jargonize one of those specific moves, the bear put spread. In simple terms, this involves buying a put option at a higher strike price while simultaneously selling a put at a lower strike price. But what does that actually mean for the portfolio in practice? Well, it means the fund can tactically maneuver to profit from a moderate market downturn without taking on that terrifying infinite risk we just talked about. It's a highly calculated, heavily fenced-in bet that a specific sector is about to cool off.
Section 5. Mechanics and how to invest. Entering the game.
All right, we're going to rapid fire through some of the strict operational rules now, starting with the benchmark. They are measuring their success against the Nifty 500 Total Return Index. Now, this is a massive baseline. It covers approximately 93% of India's listed equity market capitalization. It's honestly the perfect, broad yardstick to figure out if all this hyperactive sector rotating and derivative shorting is actually generating real alpha over simply, buying the whole market and taking a nap.
10 lakh. That's 1 million rupees. This is the minimum initial investment required both during the new fund offer period and on an ongoing basis. I think that number clearly signals the target demographic here, don't you? This is for serious, focused investors who are ready to commit meaningful capital to a pretty advanced strategy.
1%. If you decide you want out of the fund, there's a 1% exit load applied to your redemption. But hold on a second.
15 days. That 1% exit load completely disappears after just 15 days from the date of allotment. That is remarkably short, and honestly, it speaks volumes about the fund's underlying design. It tells us that while the strategy itself is highly complex, the liquidity is extremely accessible. You absolutely aren't locked in for years on end with this one.
Let's move on and see how this all builds into the operational timelines the fund manager is strictly forced to follow. During the NFO, the AMC must deploy all those gathered funds within 30 business days. And actually, this is cool. If there are passive breaches in their asset allocation, say crazy market movements dramatically push them out of their mandated limits, they have exactly 30 days to rebalance the portfolio. The clock is literally always ticking, which forces a highly disciplined management style.
Which brings us to our final thought for today. We've looked at the heavy concentration in just 4 sectors, the genuinely intriguing shorting mechanics, and those rapid-fire deployment rules. So the big question you have to ask yourself after going through this explainer is your own portfolio agile enough for this kind of aggressive sector rotation? This strategy demands deep conviction and seriously active monitoring. I highly encourage you to go read the full ISID for yourself to see if it actually aligns with your personal market views. Anyway, keep learning, stay focused, and I'll catch you on the next explainer.